Well, hello and good morning. Happy New Year. Welcome to our Tax and Budget Forum. This is our 25th time hosting this event over the 30-year history of our organization's existence. Because this event marks an important milestone for us, I'd ask your indulgence as I take us on a short trip down memory lane. Since 2020, we've elevated tax policy recommendations in a budget neutral way that would help advance family economic security in Connecticut. More specifically, although not an exhaustive list, our policy recommendations have promoted transparency through a renewed tax incidence report, as well as new tax expenditure report and tax gap analysis, called for an increase to the state's earned income tax credit, an expansion of the property tax credit for renters, as well as highlighted the value of the child tax credit in other states in service of its creation here at home, and brought to light the innovation and potential of Connecticut baby bonds. We've pursued the concept of timely payments of tax credits and indexing them to inflation, as well as the inflation index of income tax exemptions and brackets. We've elevated approaches that don't increase the tax rate at all through closing the tax gap and making adjustments to the state's fiscal controls. We've also suggested that subtracting from, not just adding to the budget, is an approach worth exploring, such as the reduction or elimination of high cost, high growth tax expenditures. And last, but certainly not least, we've consistently maintained the posture that tax fairness means the disproportionate burden ought not fall on the backs of low and middle income residents. Rather, increasing tax percentages on those that can most afford it through surcharges on the income of the ultra wealthy, as well as dynastic wealth, will help level the playing field. Each event we've held these past 5 years was framed based on the various economic and political factors, or in other words, the moment or moments in any given year that best captured the frustration of the masses. At our 20th forum, at the height of the pandemic and national racial reckoning, we framed our research and recommendations through the responsibility of collective actions and righting historical wrongs as necessary to building an economy that works for all of us, not just the privileged and lucky few. At our 21st forum, as we were shifting our organizational strategic frame, we launched our Connecticut Families Plan and explained that through universal goals and targeted approaches, we could advance family economic security in the state we love. We knew the road toward economic justice could be made faster through progressive revenue in spite of the disparate truths of residents in 169 towns and the spectrum of divergent generations and gender, which is why the frame at our 22nd forum called on all the advocates from housing and healthcare, childcare and K-12 education, labor and transportation to work together around getting more resources. At our 23rd forum, we posited that the American dream, while no longer attainable for the plurality, could still be resuscitated, ensuring the promise it once had through active, empathetic listening and the courageous policy choices made by our elected leaders. And last year at our 24th forum, reminded folks that ideas are like waves and that they don't touch everyone at the same time. And while the ripples of our work have met more people over the years, we also had a responsibility to do more at CT Voices, which is why we launched a year-long series of conversations across the state around fully funding our communities. I'm revisiting our last 5 tax and budget forums, not just because this is our 25th time hosting this event, but because in many ways, 2026 presents aspects of the same challenges from each of the preceding years, albeit the circumstances have certainly changed. The main theme that drove each forum I just reviewed has centered around affordability and the policies that make life a little easier, a little more affordable for hardworking families. Because what we were hearing and experiencing was that it was too hard for too many to make ends meet. The fact is, Connecticut is a high cost of living state, especially for low and middle income families, and it's as true today as it was in 2020. It's also true that incredible and even some exponential progress has been made over the past 5 years, and we couldn't be prouder to have supported some really exciting and really bold proposals with many of the people listening this morning. But in totality, it's unclear if these changes are enough to outweigh the decades of choices that preferenced the well-off and well-connected. The income and wealth divides are widening by the day, and it's on full display when some of the most powerful people and corporations are profiting $7 billion in a week, while many of our neighbors have no choice but to visit a food pantry to feed their families. Now, those left behind financially by a rigged economic system are having to contend with yet another big setback: the impact of the congressional megabill enacted in July of last year. I often say that justice is a horizon, not a destination. And this phrase acknowledges that the work is a process. It's imperfect, it's unfinished. And because time is both finite and fluid, it's never really complete, and that's okay, as long as we keep moving forward. Unfortunately, we find ourselves once again at a crossroads of stagnation in the best case scenario or regression in the worst case. While the state may not have created the chaos we're experiencing, it owns it now. And so the choices made by electeds will determine whether federal harms are made worse or mitigated. That being said, and as our events have reminded us, we are not without agency. Advocacy and peaceful protest are the best ways to showcase the changes we seek. Ultimately, however, our collective actions will determine whether the status quo is maintained or progress continues. The last thing I'll say is that today, it seems like affordability is a buzzword that politicians feel compelled to say. Given this, it's unclear if shared goals and shared values are driving the use of this word. So we encourage you to think about and ask the question, for whom do we want policies that would make the state more affordable? Said another way, affordability for whom? Assuming there's a shared understanding to that question, the logical subsequent question might be, are we supporting all of the policies that would effectuate the affordability we want? Today's event will spotlight the research, data, and policy recommendations to consider as you answer these questions. So with that said, I'm pleased to invite Dr. Patrick O'Brien, author of our 25th Tax and Budget Forum report, who will walk us through the findings.
So thank you, Emily, and hi, everyone, and thank you for attending our budget forum focused on our new report, the case and policy options for Connecticut to offset new federal cuts to public benefits. And I'm going to provide a lot of information in this presentation, some of which is pretty complicated. However, at the highest level, there are really just three key points that I hope you take away today. So first, a historic shift in federal policy is underway. And without sufficient state action, the harmful impact on the economic well-being of Connecticut's low and middle-income households will be substantial. Most notably, the One Big Beautiful Bill Act, or OBBA, enacted in 2025, provides significant tax cuts that heavily benefit high-income households. And the law then largely pays for those tax cuts by making cuts to public benefits and reducing essential support for low and middle-income households. The other major new federal policy is the Trump administration's expansion of tariffs, which are estimated to offset more than half the total tax cut from the One Big Beautiful Bill Act and function as a regressive tax increase that disproportionately burdens low and middle-income households. Together, these new federal policies will reduce the financial resources for low and middle-income households and shift substantial costs onto the states. Second, this historic shift in federal policy is especially troubling because even before the One Big Beautiful Bill Act and new tariffs, many households in Connecticut struggled to make ends meet. For example, an average of more than 828,000 Connecticut residents, including more than 212,000 children, were living in poverty or near poverty each year from 2022 to 2024. And third, Connecticut could fund programs to offset the new federal cuts through a combination of progressive policy options, some that do not raise tax rates and others that raise tax rates, but they're designed to generate revenue subsidized by the federal government and or offset preferential federal tax treatment. And so directly related to these key points, the primary objectives here are first, to make the case for Connecticut to offset the new federal cuts of public benefits, and second, to provide policy options. And so in support of those objectives, the report and presentation both proceed in two parts. The first part provides an overview of income, poverty, and public benefits prior to the new federal cuts to begin to make the case for Connecticut to offset those cuts. And the second part completes the case for Connecticut to offset the new federal cuts and also then provides some policy options. So let's begin now with part one, which is divided into two sections. And the first section provides an overview of income and public benefits, and it includes 4 subsections. So the first subsection addresses measuring the distribution of pre-tax cash income. And the key finding here is that the income gap between the top 1% and low middle income households is substantial in both the US and Connecticut. But it's even larger in Connecticut because of the much higher average income at the top of the distribution. And so the report addresses in detail issues with using survey and administrative data, but for the sake of time here, just note that the estimates in this table use a combination of both types of data. And so starting with the US, we see that the top 1% of households have an average pre-tax cash income of $2.27 million, which is equal to 127.2 times the average pre-tax cash income of $17,870 for the bottom 20% of households. And in Connecticut, the top 1% of households have an average pre-tax cash income of $3.66 million, which is equal to 182.5 times the average pre-tax cash income of $20,050 for the bottom 20% of households. And again, just note that the higher level of income inequality in Connecticut is due largely to the higher average income for the top 1% of households. And so this is especially important because it indicates that the state has greater capacity to generate revenue from the highest income households to fund offsets to the new federal cuts to public benefits that are really essential to low and middle income households. The second subsection examines the demographic composition of the pre-tax cash income distribution, and comparing demographics across these income groups highlights which groups are disproportionately represented at the bottom and top of the distribution and therefore experience substantial differences in economic well-being. And the key finding here is that in the US and Connecticut, low-income households are generally smaller, and they disproportionately include seniors, female residents, Black and Hispanic residents, and foreign-born residents. So for example, Black households account for 20.5% of the bottom 20% of households, even though they only account for 12.5% of all households in the state. And Hispanic households account for 23.6% of the bottom 20% of households, even though they account for less than 20% of all households in the state. The third subsection then examines how public benefits affect total resources across the entire income distribution. And so using the US Census Bureau's supplemental poverty measure framework, this analysis defines total resources by combining income, public benefits, taxes, and essential expenses. So first, resources include pre-tax cash income, which incorporates cash public benefits, such as Social Security, unemployment insurance, and supplemental security income. Second, resources include non-cash public benefits, which are added income. These include food and housing assistance programs such as SNAP and housing vouchers. Third, taxes are subtracted from resources, and importantly, tax-based public benefits such as the child tax credit and the earned income tax credit reduce the amount of taxes subtracted and therefore increase total resources. And fourth, certain essential expenses are subtracted from resources. So these include out-of-pocket medical expenses, work and childcare expenses, and child support. And public benefits are incorporated here as well because health insurance, such as Medicaid and Medicare, along with childcare subsidies, substantially reduce the amount of these expenses before they're subtracted. And then finally, once we add pre-tax cash income and non-cash benefits and subtract taxes and certain essential expenses, the result is total resources. And this is what households have left to spend on basic necessities, including food, clothing, shelter, and utilities. And again, importantly, this approach incorporates the full combined impact of the public benefits system. So now to examine how public benefits actually affect total resources across the income distribution, we'll use survey data from 2022 to 2024, which are the 3 most recent years available. And in the table here, the middle column shows averages for the bottom 20% of households, and the third column shows averages for the top 10% of households. And note that in the report, the analysis covers the entire income distribution, but just for the sake of time and simplicity, here we're just comparing the bottom and the top of the distribution. And so to begin, the data show that cash public benefits are progressive, providing a much larger share of income for low-income households and for high-income households. though they also provide meaningful support to households across the distribution. Specifically, the bottom 20% of households have an average pre-tax cash income of just over $20,000, and more than $10,000, or 50.5% of that, comes from cash public benefits. In contrast, the top 10% of households have an average pre-tax cash income of over $490,000, and about $8,000, or 1.6%, comes from cash public benefits. Second, the data shows that non-cash public benefits, which again includes food and housing assistance, are also progressive, providing substantial support for low-income households and little to no support for middle and high-income households. Specifically, the bottom 20% of households receive non-cash benefits valued at nearly $4,000, equal to about 20% of their pre-tax cash income. And in comparison, the top 10% of households receive on average benefits valued at $150, which is equal to less than 0.1% of their pre-tax cash income. Third, the data show that the federal, state, and local tax system is progressive overall, due in part to tax-based public benefits. Specifically, when combining all taxes, the bottom 20% of households pay an average of 15.5% of their pre-tax cash income in taxes, compared with 34.2% for the top 10% of households, making the overall system progressive. However, this progressivity is driven by federal taxes. In contrast, state and local taxes are regressive. Specifically, the bottom 20% of households pay an average of 14.7% of their pre-tax cash income, compared to just 8% for the top 10% of households. And so this distinction is especially important because the federal government's shifting responsibility for a substantial share of healthcare and food assistance to the states. And if states then use regressive revenue sources to fund those benefits, they're going to partially offset the benefits through the very funding of them. And so it's really critical for states to use progressive revenue sources when expanding public benefits to offset the new federal cut. Fourth, healthcare and childcare public benefits are progressive, providing support primarily for low and middle income households and reducing the disproportionately high share of income that they spend on these essential expenses. And just to be clear, although low income households pay a higher percentage of their income on these expenses, the public benefits that reduce them are highly progressive. So for example, as reviewed in the report, out-of-pocket medical costs are the largest expense in this category, and nearly 77% of Connecticut residents in the bottom 20% of households have public health insurance, compared with less than 11% of Connecticut residents in the top 10% of households. Finally, the data show that the overall impact of the public benefit system on total resources prior to the new federal cuts is progressive in both the US and Connecticut, providing essential support primarily for low and middle income households. Again, however, the state and local tax system is regressive, making it important to fund any new state level expansion of public benefits with progressive resources. So specifically, after accounting for all four categories, we see that the bottom 20% of households have an average of $18,110 in total resources, equal to 90.3% of their pre-tax cash income. In contrast, the top 10% of households have an average of nearly $302,000 in total resources, equal to 61.5% of their pre-tax cash income. And again, this measure of total resources is the amount households have left to spend on food, clothing, shelters, utilities, and other basic necessities. Lastly, the fourth subsection here examines difficulty paying usual household expenses. And this step's essential for assessing whether, even with a progressive public benefit system and prior to the new federal cuts, households have sufficient support to meet basic needs. And the key finding here is that even with the progressive public benefit system, and again, prior to the new federal cuts, a majority of adult residents in the US and Connecticut report difficulty paying usual household expenses, especially households with children. So using data from another Census Bureau survey, the table here shows whether adult residents reported paying usual household expenses was not at all difficult or difficult. And the difficult category combines responses of a little difficult, somewhat difficult, and very difficult. And looking first at all adult residents in the state in 2024, only 35.5% reported that paying usual household expenses was not at all difficult. In contrast, nearly 65% reported some level of difficulty, including nearly 16% who said that it was very difficult. The data also showed that adults living with children experienced substantially higher rates of difficulty. So among those residents, nearly 75% reported difficulty paying usual household expenses, including more than 21% who reported that it was very difficult. Additionally, female residents and Black and Hispanic residents report above average levels of difficulty. For example, among Black residents, only about 17% reported no difficulty, while more than 83% reported some level of difficulty, including nearly 28% who reported that it was very difficult. So this brings us now to the second section of part one, and this is an overview of poverty and public benefits. And focusing specifically on poverty and public benefits, in addition to the preceding analysis of the entire income distribution, this is really essential because residents living in poverty or near poverty experience the greatest economic hardships and also rely most heavily on public benefits. And so this section's divided into three subsections. And the first subsection addresses measuring poverty using the official poverty measure and the supplemental poverty measure, which are the federal government's two primary measures. And we'll start with the official poverty measure, OPM. Notably, the OPM measures resources using only pre-tax cash income and also then uses a single national poverty threshold based on 3 times the cost of a minimum food diet in the early 1960s, adjusted for inflation. And the OPM is the most commonly cited measure of poverty, but it's also highly flawed because it excludes non-cash public benefits, taxes, and essential expenses, and it relies on an outdated poverty threshold. So to address these shortcomings, the federal government created the Supplemental Poverty Measure, or SPM. And as mentioned, the earlier analysis here examining the impact of public benefits on total resources used the SPM framework, which again includes pre-tax cash income, adds non-cash public benefits, and subtracts taxes and certain essential expenses after accounting for tax-based benefits and other public benefits such as for healthcare and childcare. Additionally, the SPM uses a more comprehensive poverty threshold that reflects recent spending on essential items, and it also adjusts for geographic differences in housing costs. And so just overall, the SPM is a far superior measure of poverty, and it's the primary one used throughout the remainder of this analysis. So now, the key finding here is that even with a progressive public benefit system and prior to the new federal cuts, poverty and near poverty rates, especially for children, are high in the US and Connecticut and have increased in recent years. Focusing first on all residents, the data show that on average, more than 365,000 residents in Connecticut, equal to 10.1% of the population, were living in poverty prior to the new federal cuts. And when including residents living in near poverty, the rate increases to 22.8%, which is equal to more than 828,000 residents. For children, the rates are even higher, on average 11.7%, or more than 84,000 children in the state were living in poverty prior to the new federal cuts. And when including children living in near poverty, the rate increases to 29.3%, which is equal to more than 212,000 children. The second subsection examines SPM-based poverty estimates by demographic groups, and comparing poverty rates across these groups highlights which populations experience disparities in economic well-being. And the key finding here is that in both the US and Connecticut, poverty and near poverty rates are higher than average, not only for children, but also for female residents, Black and Hispanic residents, and foreign-born residents. So for example, on average, 30.5% of Black residents in the state were living in poverty or near poverty prior to the new federal cuts. And 42.5% of Hispanic residents were living in poverty or near poverty, which is nearly double the rate for all residents. The third and final subsection for this part examines the impact of public benefits on SPM-based poverty, and it highlights just 2 key findings here. So the first key finding is that prior to the new federal cuts, food assistance through the Supplemental Nutrition Assistance Program, or SNAP, is the 3rd largest poverty-reducing public benefit in both the US and Connecticut. And to highlight the impact, the table here shows the change in residents below the SPM-based poverty threshold, including both the number of people and the percentage point change. So focusing on SNAP, the data show that on average, the program reduces the number of Connecticut residents living in poverty each year by 45,200. And this includes lifting an average of 19,600 children out of poverty each year. The second key finding is that prior to the new federal cuts, out-of-pocket medical expenses are the largest contributor to poverty in both the US and Connecticut, and that's even after accounting for healthcare benefits, including Medicaid, Medicare, and the premium tax credit. Specifically, the data show that medical out-of-pocket expenses push an average of 65,500 Connecticut residents into poverty each year, primarily 40,400 adults. But these expenses also push an average of 13,600 children in Connecticut into poverty each year. And again, to be clear, these estimates already account for public health care benefits, and they're prior to the new federal cuts, underscoring the potential impact of those new cuts on Connecticut's households and residents. So this brings us to the end of part one. And so we're going to stop here and provide a quick recap and have a brief discussion.
Excellent. Thank you so much, Patrick, for all that. There's obviously a lot of data in the presentation. And so again, I just want to remind everyone that we understand most people won't be able to digest everything right away, and that's okay. We're going to try to help unpack some of this. So to help folks process, we're going to do this Q&A style after each of the presentations. This is part one. We're going to do one after part two. So first question, Patrick, what are the most important takeaways from part one?
Yeah, so part one, again, included two sections, and the first section examined income and public benefits, and there were three key findings there. So first, the income gap between the top 1% and low and middle income households, it's substantial in both the US and Connecticut, but it's even larger in Connecticut. And this is important because it indicates that the state has greater capacity to generate revenue from the highest income households to fund offsets to the new federal cuts to public benefits. Second, the overall impact of the public benefit system on total resources prior to the new federal cuts, it's progressive in both the US and Connecticut. However, the state and local tax system is regressive, making it really important to fund any new state level expansion of public benefits with progressive revenue sources. And third, even with a progressive public benefit system, and again, prior to the new cuts, a majority of adult residents in the US and Connecticut, especially those with children, self-reported difficulty paying their usual household expenses. And then the second section zoomed in on poverty and public benefits, and that had three key findings as well. So first, even with a progressive public benefit system and prior to the cuts, poverty and near poverty rates, especially for children, are high in the US and Connecticut. Second, prior to the cuts, food assistance through SNAP is the third largest anti-poverty reducing program in a public benefit in both the US and Connecticut. And third, and prior to the cuts, out-of-pocket medical expenses are the largest contributor to poverty in both the US and Connecticut. And again, that's after accounting for healthcare benefits.
I'm going to boil that down even more. The income gap is still wide, especially in Connecticut. State and local tax system is regressive, which means we have the resources to help offset federal gaps, and progressive revenue sources to do so will be important. And even with the progressive public benefit system, a majority of households, and especially those with children, report difficulty paying the usual household expenses. What's more, poverty and near poverty rates, especially for children, are high in the US and Connecticut. SNAP is critical to reducing poverty, and out-of-pocket medical expenses are the largest contributor to poverty. So check. Let's talk about the data for a moment. Originally, we were going to publish our second report on the state of poverty in American Connecticut in October of last year. However, we also knew that our tax and budget forum topic was going to focus on the tax components of the congressional mega bill, HR 1. And so given the topical proximity, we've combined both reports. And so that's why we've got a part one and part two, which is mirrored in this event. In our first poverty report, we spent several pages discussing the differences between the official poverty measure, OPM, and the supplemental poverty measure, SPM. But I think a quick refresher might be helpful. So Patrick, please remind us what's included in the OPM versus the SPM.
Yeah. So again, the federal government provides these two different measures. You have the official poverty measure, or OPM, and that just simply includes pre-tax cash income, which incorporates cash public benefits such as Social Security. And it's the most commonly cited measure, but it's just also highly flawed because it excludes a lot of these non-cash public benefits, as well as taxes and essential expenses, and it relies on an outdated threshold. So to address these shortcomings with the OPM, the federal government created the supplemental poverty measure, or SPM. And this measure includes pre-tax cash income and cash public benefits. It adds non-cash public benefits, including food and housing assistance, and it subtracts taxes and certain essential expenses. And that's after accounting for tax-based public benefits and other public benefits, such as for healthcare and childcare. The SPM also just uses a more comprehensive threshold that reflects recent spending on essential items, and it adjusts for geographic differences for housing costs. And so all those factors make the SPM a much superior measure of poverty than the OPM.
So it sounds like neither is perfect, but the SPM is better. What does the state use, OPM or SPM?
Yeah, so states generally don't have their own measures of poverty, but instead they can just use either the OPM or the SPM, and they just measure it at the state level. And so, as we mentioned in the report for Connecticut, the SPM-based poverty rate averaged 10.1% over the last 3 years in Connecticut. And then when you include those living in near poverty, the rate increased to an average of 22.8%.
Great. One of the phrases to describe a segment of the population that's struggling financially is ALICE. We hear this term a lot. The United Way coined it, asset limited income, constrained and employed, to explain a group of people who didn't either meet OPM or SPM poverty definitions, but nor do they earn enough to live comfortably. So the next question is, where do ALICE residents fall along the income distribution?
Yeah, so there are several prominent measures of economic well-being that look beyond poverty or even near poverty, and we can really think of these measures essentially as being on a spectrum. So the poverty measures highlight the residents that are experiencing the most severe economic circumstances, and other measures that incorporate those residents as well as other residents struggling to make ends meet. So as you mentioned, there's the United Way's ALICE measure, and it identifies households that are struggling to afford basic needs. Using that measure in Connecticut in 2023, 40% of households were below their survival budget. For another example, there's the US Census Bureau survey that allows households to self-report their difficulty paying usual household expenses. And in 2024, nearly 65% of residents reported some level of difficulty paying their usual expenses. So overall, there are several different measures to use, each of which has certain strengths and weaknesses. But I think the key point here is that regardless of the measure used, a substantial percent of Connecticut residents have been struggling to make ends meet. And again, that's prior to the new federal cuts.
Sure, that's helpful for folks. Lastly, we just saw in the presentation that SNAP is critical to lifting up families out of poverty in Connecticut. What are the other top benefits that help people out of poverty in Connecticut, and are they different from the top 5 for the US as a whole?
Yeah, so the top 4 public benefits for lifting people out of poverty are the same in both the US and Connecticut, but the ranking differs for 2 of them. So using the SPM framework in the US, the most important public benefits for lifting people out of poverty are 1, Social Security, 2, the federal income tax, when you include both the refundable child tax credit and the earned income tax credit, 3, SNAP, which again provides food assistance, and then 4 is housing assistance. For Connecticut, they're the same. It's just housing assistance is number 2 in the federal income tax, and including the refundable tax credits is number 4. Additionally, though, it's also important to mention again how healthcare benefits are measured. So using the SPM framework, the value of healthcare benefits, it's not added to total resources. Rather, out-of-pocket healthcare expenses are subtracted from total resources. So for example, programs such as Medicaid and Medicare, they protect households from high medical costs, and the value of that public benefit is incorporated into household resources, not through the dollar amount of the subsidy, but through the reduced out-of-pocket spending compared with what would otherwise occur. And so importantly, when we look at the expenses that most contribute to poverty, medical out-of-pocket expenses rank number 1 in both the US and Connecticut. Additionally, if the SPM framework is modified to incorporate the value of healthcare benefits rather than the reduction in out-of-pocket expenses, which is an experimental approach that the Census Bureau has been working on, then Medicaid and Medicare tend to rank just behind Social Security in their importance. So overall, when focusing on lifting people out of poverty, as well as the expenses that push people into poverty, the most important public benefits include Social Security, Medicaid and Medicare, the federal income tax, and including the refundable tax credits, food assistance through SNAP, and housing assistance.
Okay, great. So this is the foundation, folks, for the data that you're about to hear in part 2. So as Patrick pulls up the slide deck, I just want to remind everyone that part 2 focuses on the congressional megabill's new tax policies and the impact on healthcare benefits and food assistance, as well as policy recommendations to mitigate as much harm to people as possible. So let's listen in and learn more about this in part 2. Patrick.
All right, thanks, Emily. So as she just mentioned, we're going to start part 2 now, which completes the case for Connecticut to offset the new federal cuts of public benefits, and it also provides policy options. So this part includes 1 section on offsetting the new federal cuts, and the section is divided into 3 subsections. The first section provides and subsection provides an overview of the new federal policies. So to begin, the One Big Beautiful Bill Act, or OBA, reduces healthcare benefits. This includes an estimated $990 billion cut to Medicaid over the next decade, along with a $532 billion cut to the premium tax credit when including the expiration of the enhanced credit. As a result, an estimated 14.2 million people in the US, including 150,000 Connecticut residents, will lose health insurance coverage. Also, as just discussed, this is especially important because medical out-of-pocket expenses are the largest expense contributing to poverty in both the US and Connecticut. Second, the One Big Beautiful Bill Act reduces food assistance. Specifically, the law includes an estimated $187 billion reduction in food assistance spending over the next decade, primarily through cuts to SNAP. As a result, an estimated 22 million households in the US, including 220,000 households in Connecticut who receive SNAP, will be harmed by the change to the Thrifty Food Plan. Additionally, an estimated 5.3 million households in the US, including 58,000 households in the state, will lose substantial benefits. And for those affected households in Connecticut, the cut will average $193 per month in benefits. And this is especially important because, as we just discussed, SNAP is one of the largest anti-poverty programs in both the US and Connecticut. And third, the One Big Beautiful Bill Act disproportionately reduces taxes for high-income families, and at the same time, tariffs disproportionately increase taxes on low and middle-income families. In particular, the One Big Beautiful Bill Act includes an estimated $4.5 trillion reduction in taxes over the next decade, and taxpayers making more than $500,000 a year will receive an estimated 33% of the total tax cut, equal to $1.5 trillion over the 10-year period. And that's nearly equal to the combined cuts to healthcare and food assistance that primarily benefit low and middle income families. Additionally, the tariffs are estimated to raise $2.5 trillion over the next decade, offsetting more than half of the One Big Beautiful Bill Act tax cuts. And importantly, the tariffs function as a regressive tax increase that disproportionately burdens low and middle income households because those households tend to spend a larger percentage of their income on the goods affected by tariffs. Next, the second subsection provides a distributional analysis of the new federal policies. So the key finding here is that these policies will make the public benefit system less progressive, reducing essential support for low and middle income households, especially those living in poverty and near poverty, while increasing support for high income households. And to demonstrate, the table here shows the impact on Connecticut households. Importantly, this analysis presents two separate sets of estimates of the tariff impact. The first set of estimates includes all tariffs in effect as of mid-November 2025. And the second set of estimates exclude the tariffs imposed under the International Emergency Economic Powers Act, or IEPA. And this distinction is necessary because the Supreme Court's considering a case that may invalidate the IEPA tariffs. Like the earlier distribution analysis, the second column provides the estimates for the bottom 20% of households, and the third column provides the estimates for the top 10%. And so first, the One Big Beautiful Bill Act is estimated to reduce resources for the bottom 20% of households in Connecticut by an average of $690, equal to a decrease of 3.4% of their pre-tax cash income. In contrast, the top 10% of households will gain an average of $13,040 in resources, equal to an increase of 2.6%. Second, the Trump administration tariffs will reduce resources across the income distribution through higher prices and or lower incomes, but they'll disproportionately burden low and middle income households. So for the bottom 20% of households in Connecticut, the full tariffs will reduce resources by an average of $950, equal to a decrease of 4.6% of their pre-tax cash income. Or when excluding the IEPA tariffs, the remaining tariffs will reduce resources by an average of $400, equal to a decrease of 1.9%. In contrast, the top 10% of households with the full tariffs will lose an average of $3,780 in resources, equal to a decrease of just 0.8%. Or when excluding the IEPA tariffs, they'll lose an average of $1,770, equal to a decrease of just 0.4%. Finally, in both the US and Connecticut, the combined impact of the One Big Beautiful Bill Act and the new tariffs will make the public benefit system less progressive by decreasing resources for low and middle income households while increasing resources for high income households. Specifically, the bottom 20% of households in Connecticut will experience substantial losses under both tariff scenarios. With the One Big Beautiful Bill Act in full, terrorists will lose an average of $1,630 in resources, equal to a decrease of 7.9% of their pre-tax cash income, or when excluding the IEPA terrorists will lose an average of $1,090, equal to a decrease of 5.3%. In contrast, the top 10% of households in Connecticut will experience substantial benefits under both scenarios. With the One Big Beautiful Bill Act in full, terrorists will gain an average of $9,260, equal to a gain of 1.8%, or when excluding the IEPA terrorists, they'll gain an average of $11,270, equal to a gain of 2.2%. The third and final subsection provides progressive policy options to raise revenue and offset the new federal cuts to public benefits. And so this starts with an estimate of fully offsetting the cuts to healthcare and food assistance, which are the major cuts in the One Big Beautiful Bill Act. And the key finding here is that offsetting just these federal cuts will cost Connecticut nearly $1 billion in the next fiscal year and substantially more in subsequent years. Specifically for the current biennium budget, Connecticut's estimated share of the federal cuts is $480 million in FY26 and just under $1 billion in FY27. For the FY28 to 29 biennium, the budget cuts increase to an average of $1.4 billion a year. For the FY30 to 31 biennium, the budget cuts increase to an average of $1.9 billion a year. And for the FY32 to 33 biennium, the budget cuts increase to an average of $2.4 billion a year. Next, to offset those substantial federal cuts, Connecticut could raise revenue through a combination of progressive policy options. Importantly, some of the policy options do not require raising tax rates, and these categories include adjusting Connecticut's revenue controls and reducing Connecticut's tax gap, and they could easily bring in more than $1 billion a year in revenue. Additionally, some of the policy options raise tax rates but are well targeted and generate revenue subsidized by the federal government and/or offset preferential federal tax treatment. And these categories include establishing surcharges on targeted income from high-income households and reforming Connecticut's estate tax on high-value homes. And these options could raise close to $500 million per year, and the rates could be increased if additional revenue is needed. So the analysis that follows reviews each of the four categories and the associated policy options. So as noted, the first category is adjusting Connecticut's revenue controls, which includes two policy options. First policy option in this category is to adjust the volatility cap threshold using a 5-year, 10-year inflation-adjusted moving average of the covered volatile revenue. And just for some important context, the purpose of the volatility cap is to limit the impact on the budget of year-to-year fluctuations in volatile revenue sources. However, based on its design, the volatility cap has been excessively restrictive. Specifically, from fiscal years 2018 to 2025, the volatility cap restricted an average of $1.5 billion a year for a total of $12 billion. However, using a simple 5-year inflation-adjusted moving average cap would have freed up an average of nearly $760 million a year during this period. Or using a simple 10-year inflation-adjusted moving average would have freed up an average of nearly $480 million a year. Another key point is that this is a progressive source of additional revenue because the excessively restricted funds come from two taxes, both of which are disproportionately paid by high-income households. Also, as noted, this policy doesn't require raising tax rates. Last key point is that policymakers recently increased the volatility cap threshold by $150 million for FY25 and by $600 million for FY26. However, even after that recent adjustment, the volatility cap remains excessively restrictive. For example, compared to the current recently adjusted cap, using a simple 5-year inflation-adjusted moving average would still free up an estimated $926 million for FY26 and $1.2 billion for FY27. Adjusting Connecticut's revenue controls also includes a second policy option, which is to increase the maximum capacity of the Budget Reserve Fund to 20 or 25%. The Budget Reserve Fund holds surplus revenue in strong economic years to offset revenue shortfalls in weaker years, especially during a recession. However, as the OPM's recent recession stress test shows, the current Budget Reserve Fund cannot fully cover the revenue shortfall over a 3-year period associated with either a moderate or a severe recession. Specifically, after fully employing the Budget Reserve Fund, a moderate recession would result in a revenue shortfall of $1.1 billion, and a severe recession would result in a shortfall of $4.5 billion, which would require either tax increases, spending cuts, or both. Additionally, the stress test estimates do not incorporate the federal funding shortfall caused by the One Big Beautiful Bill Act. And so that just means that the actual fiscal risk to the state is even larger. Another key point is that this is a progressive source of additional revenue because the increase in the budget reserve fund could be entirely funded by the volatility cap in order to not affect the new early care fund. And as noted, revenue restricted by the volatility caps disproportionately paid by high-income households. Also, as noted earlier, this option would not require raising tax rates. And the last key point here is that this simple policy adjustment would provide an additional $1.8 billion in reserve revenue in FY27 to respond to federal cuts and or a recession if, for example, the cap is increased to 25%. The second category of policy options is to reduce Connecticut's tax gap. And this includes the option to increase auditing to reduce the state's tax gap by 5 to 10%. For important context, the tax gap is the difference between the amount of taxes legally owed and the amount actually paid. And there are two primary measures of it. The gross tax gap is the amount of taxes owed but not paid by the due date. And then the net tax gap is the amount still unpaid after accounting for late payments and enforcement actions. And there are several key points to highlight here. So first, the DRS estimates that the net tax gap is 12.4%, which in 2024, the year covered by their analysis, equaled about $3 billion. Applying that same percentage to the current budget projection suggests that the net tax gap is about $4 billion per year for FY26 and FY27. The second key point here is that addressing the state's tax gap is increasingly important because recent federal cuts to the IRS will limit the federal government's ability to reduce its substantial tax gap, and that in turn will carry through in part to Connecticut's individual and corporate income taxes because of the close relationship between federal and state tax system. Another key point is that this is a progressive source of additional revenue if enforcement efforts are targeted at high-income households, which are disproportionately responsible for the tax gap due to the underreporting of income. And as noted, this option does not require raising tax rates. And the final key point here is that decreasing the state's tax cap by, for example, just 10% would provide an average of $400 million per year for the current budget. The next category of policy options is to establish Connecticut surcharges on targeted income from high-income households. And this category includes 3 policy options. The first option is to establish a 1 percentage point surcharge on the Connecticut pass-through entity tax and reduce the credit to 83.6%. This would raise an estimated $60 million per year. The second option is to establish a 10 percentage point surcharge on the federal qualified business income deduction, which is estimated to raise $110 million per year. And the third policy option is to establish a 1 percentage point surcharge on capital gains and dividend income, which is estimated to raise $235 million per year. So together, these options would raise more than $400 million a year in revenue. And just for the sake of time, and because all 3 of these options are similar in that they establish surcharges on targeted income from high-income households, I'm going to only review the first policy option here, but just note that the report includes details on all 3. So as mentioned, the first policy option in this category is to establish a 1 percentage point surcharge on the pass-through entity tax and reduce the credit. And the first key point here is that Connecticut's pass-through entity tax allows taxpayers to receive preferential federal tax treatment for business income compared to wages and salaries. And the tax dynamics are really, really complicated, so I'm going to try to use a few examples to just quickly demonstrate what this means. So to start, if we look at example 1 here, this is for a married tax filer in Connecticut with $2 million in income from wages or a salary. This taxpayer pays 32.8% of their income in the federal income tax and 6.99% in the Connecticut income tax for a combined tax burden of about 39.8%. Next, example 2 shows a married tax filer in Connecticut with $2 million in business income and that pays a Connecticut pass-through entity tax and receives a credit of 93.01%, which was the initial level of the credit. This taxpayer pays 30.2% of their income in the federal income tax and 6.99% in Connecticut taxes for a combined tax burden of 37.2%. So in this case, using the Connecticut pass-through entity tax workaround saves the taxpayer nearly $52,000 in their federal tax burden while leaving their Connecticut tax burden unchanged. Now, example 3 shows a married tax filer in Connecticut with $2 million in business income and that pays the Connecticut pass-through entity tax and receives a credit of 87.5%, which is the current level of the credit. This taxpayer pays 30.2% of their income in the federal income tax and 7.37% in Connecticut taxes for a combined burden of 37.5%. So in this case, the Connecticut pass-through entity tax still reduces the federal income tax by 2.6 percentage points or nearly $52,000, but the Connecticut tax burden increases by 0.38 percentage points or about $7,700. And this just means that Connecticut captures part of the federal tax benefit while the taxpayer still pays less in total taxes than they would without the workaround. So again, these are just some examples to try to quickly demonstrate that Connecticut's pass-through entity tax allows taxpayers to receive preferential federal tax treatment for business income compared to wages and salaries. The next key point here is that the proposed Connecticut surcharge and reduced tax credit would be entirely subsidized by the federal government. It would only apply to targeted income from high-income households. So to demonstrate, let's return to the previous examples, and we'll now add a fourth example. And so this shows a married tax filer in Connecticut with $2 million in business income and that pays the Connecticut pass-through entity tax with a 1 percentage point surcharge and a reduced credit. This taxpayer pays 29.8% of their income in the federal income tax and 7.74% in Connecticut taxes for a combined burden of 37.5%. This is the same as the current tax burden demonstrated in example 3. However, the composition of the tax burden changes. The federal income tax decreases by about 0.4 percentage points or $7,400, and the Connecticut tax increases by about 0.4 percentage points or about $7,400, shifting revenue from the federal government to the state while leaving the total burden for the taxpayer unchanged. And now I realize that this is just really, really complicated, especially without spending more time on it. And so just to try to be a little clear here, the point is simply that the total federal and state tax burden is unchanged after adding the Connecticut surcharge and reducing the credit. However, Connecticut gets more revenue because the federal tax cut offsets the state tax increase, meaning the federal government's effectively subsidizing this tax increase in revenue for Connecticut. Returning to the key points, the last key point is that this policy option is estimated to raise $60 million a year and again would be subsidized by the federal government. Finally, the fourth category of policy options is to reform Connecticut's estate tax on high value estates. And this category includes 2 policy options which are connected, and so I'm going to review both of them together. So the first policy option is to establish a Connecticut estate tax recapture for estates exceeding the exemption and exclude the additional payment from the tax from the payment cap. And the second policy is to establish a Connecticut alternative minimum estate tax to keep the effective net state tax rate from falling below 2%. And the first key point here is that Connecticut is the only state that links its estate tax exemption to the federal exemption, which has increased the state's exemption from $2 million in 2017 to $15 million in 2026. And the second key point is that Connecticut is the only state with an estate tax payment cap, which is currently set at $15 million. So together, the increased exemption and the estate tax payment cap create a system in which Connecticut taxes fewer estates. It collects less revenue from the states that it does tax, and among taxable estates, it tends to provide the lowest effective tax rates to the highest value estates. So to address these issues, Connecticut could establish 2 policy options here, and these reforms would be largely subsidized by the federal government, would only apply to high value estates. And here too, the tax dynamics, they're really complicated, and so I'm going to try to just use a few simple examples to attempt to demonstrate what this means. So to start, look at example 1 here, which is an estate in 2026 with a value of $15 million. In this case, Connecticut's regular estate tax is $0. Next, example 2 shows an estate worth $250 million, and that's subject to the regular estate tax as well as to the proposed tax recapture. In this case, the regular estate tax is $15 million, and the estate tax recapture is $1.8 million for a total Connecticut estate tax of $16.8 million, equal to 6.7% of the state's value. However, because the federal and Connecticut estate tax exemptions are linked, this estate is also subject to the federal estate tax. And at the federal level, state estate taxes are deductible, which results in the federal government subsidizing 40% of Connecticut's estate tax. So for this example, even though Connecticut's total estate tax is $16.8 million, the federal government subsidizes $6.7 million of that tax, meaning that the net Connecticut tax for the state to pay is only $10.08 million, even though the Connecticut government's receiving $16.8 million in revenue. And lastly, example 3 shows an estate worth $1 billion, and that's subject to the regular estate tax as well as the proposed tax recapture and alternative minimum tax. In this case, the regular estate tax is $15 million. The estate tax recapture is $1.8 million, and the alternative minimum tax is $9.9 million for a total Connecticut estate tax of $33.3 million, equal to just 3.3% of the estate's value. So this is the amount of revenue that Connecticut would receive. However, the federal government would subsidize 40% of Connecticut's estate tax, meaning the net Connecticut estate tax for the state to pay would only be $20 million, equal to just 2% of the estate's value. So again, I realize that this is very complicated in a short amount of time, but these are an attempt to provide some basic examples to demonstrate that Connecticut's estate tax reforms would be largely subsidized by the federal government and would only apply to high value estates. And so the final key point is that these options together are estimated to raise $82.5 million per year. And so this brings us to the end of part 2. And similar to the end of part 1, we're going to stop here and provide a quick recap and brief discussion.
So full wording here, we are definitely going to go over our time a little bit, but we realize if folks need to hop off, that's fine. But we are going to keep moving through the Q&A because we think it's important. And so we will be sharing out the recording for folks who are on the call, just as a heads up. So thanks, Patrick, for that. And like you did in part 1, maybe you can help us understand the most important takeaways from what we just heard in part 2.
Yeah, so there are just the one section in part 2 and 3 key findings really at a high level. First, the combined impact of the One Big Beautiful Bill Act and new tariffs will make the public benefit system less progressive. Second, offsetting the federal cuts to healthcare benefits and food assistance alone will cost Connecticut nearly an estimated $1 billion in the next fiscal year and substantially more in subsequent years. And third, Connecticut could fund programs to offset the new federal cuts through a combination of progressive policy options, some that do not raise tax rates and others that raise tax rates, but they're designed to generate revenue subsidized by the federal government and or offset preferential federal tax treatment.
Yeah, I think it's important, and we actually state this in the report, that the projected cuts to Connecticut of roughly $500 million in fiscal year 26, nearly $1 billion in fiscal year 27, and over $2 billion 5 years from now in fiscal year 23 are just those included within HR 1. If you're paying attention to the news, the U.S. House of Representatives is slated to vote on a clean 3-year extension of the premium tax credit enhancements today, which would then have to be voted on by the Senate if it passes. To be clear, we absolutely hope this extension is enacted, as it would help the state as well as Connecticut residents. However, even if it passes both chambers, throughout the month of January, Congress will continue to negotiate additional spending bills, which may include cuts that are unnamed in our report. Additionally, our projected cuts to Connecticut don't include cuts to programs for higher education, student loans, or environmental protection grants that are included in HR 1, nor do we include potential reductions through executive orders, some of which may be substantial. So focusing in on just HR 1, Patrick, and just the cuts to healthcare benefits and food assistance, what impact on poverty would you expect to see from in the future?
Yeah, so as we discussed, healthcare and food assistance are 2 of the most important forms of public benefits in both the U.S. and Connecticut. And so without sufficient action at the state level and just holding all else equal, including the state of the economy, the major federal cuts to healthcare and food assistance is going to result in more low and middle income families, households struggling to make ends meet, and even more residents living in poverty. And so we don't have specific poverty impacts due to the new federal cuts, but really any increase in poverty is especially troubling because even prior to the new federal cuts, we saw that many families in Connecticut were struggling. Again, based on the SPM, an average of 11.7% or more than 84,000 children in the state were living in poverty. And when you include near poverty, the rate increases to 29.3% or more than 212,000 children in the state. So really any increase to those numbers is concerning.
Yeah, absolutely. As always, our Tax and Budget Forum report doesn't just highlight challenges, we also present solutions. This year, we offer four broad policy recommendations that are broken up into two buckets, and those that include no increases in the tax rates, and those that increase the tax rate but leverage the federal policy changes from the congressional mega bill to lessen the impact of said proposed new tax. It's the second bucket of policy options that are arguably the ones harder to digest, especially for folks who are less familiar with tax policy. And in fact, in your presentation, you noted a few times, right, that these proposals are really complicated. So let's try to simplify them as much as possible. Why are these recommendations so complicated? What specifically makes them complicated?
Yeah, so the second two categories of policy options, as mentioned, require raising tax rates, but they're designed to generate revenue through income tax surcharges or state tax reforms that are subsidized by the federal government and or offset preferential federal tax treatment. So these policies are just very complicated because they're designed to offset in part the very complicated tax changes that the federal government made for the federal tax system. In particular, the One Big Beautiful Bill Act established some complicated and very large tax breaks for business income and high value estates. So, for example, the federal extension and expansion of the federal qualified business income deduction and the changes to the federal estate tax together, that totals nearly $1 trillion, which is about the same as the entire cost of the cuts to Medicaid. And so, if at the state level we want to offset cuts to healthcare, one very effective way to do that would be to partially offset the tax cuts for business income and high value estates. Additionally, if we want to maximize the revenue from state level tax changes while minimizing as much as possible the increased tax burden on the state's residents, that requires developing more complicated proposals than would just otherwise be the case. So again, the primary reason some of the policy options here are really complicated is just simply because they're proposing to partially reverse at the state level the negative impact of the One Big Beautiful Bill Act, and doing that as effectively as possible requires making some changes that are as complicated as the tax provisions in the federal law.
Makes sense. The last question for you is, what are the biggest takeaways from the full report?
Yeah, so as I mentioned at the very start of the presentation, at the highest level, there are really just three key takeaways, and everything else is provided in support of these points. So first, a historic shift in federal policies underway, and without sufficient state action, the harmful impact on the economic well-being of Connecticut's low and middle-income households will be substantial. Second, this historic shift in federal policy is especially troubling because even before the One Big Beautiful Bill Act and new tariffs, many households in Connecticut struggle to make ends meet. And third, Connecticut could and should fund programs to offset the new federal cuts through a combination of progressive policy options.
Terrific. Thanks, Patrick. And again, many thanks to everyone who joined us this morning at our 25th Tax and Budget Forum. We know that there was a lot of information, and so we invite you to rewatch the event, as we believe hearing the presentation again will sound differently the second time. Or if you're feeling ambitious, please read the full report. Additionally, if you're a partner, we're happy to dig deeper with you on the research and recommendations. So if you're interested in learning more, send us an email. Lastly, at Connecticut Voices for Children, we believe every policy and every funding decision should lead us to the future we want, which is a fair and just society where all children reach their full potential. If you share this vision for a better world, we encourage you to visit our website and sign up for our email list, as well as join our Tax Fairness and Equity Coalition or the numerous coalitions of incredible advocates across the state. On behalf of the whole team at CT Voices, we wish everyone a very happy, healthy, and prosperous new year filled with love, renewable hope, and the courage to act.